Hi, welcome everyone. This is the first in our webinar series of 10 webinars with Clive Lambert of Futures Techs, who's hopefully going to try and make some sense of reading charts, chart patterns, and sort of improving how we trade and how we read the charts. So I'll pass you over to Clive. Clive, if you're there.
Hello, how you doing? Can you hear me okay?
Yeah, perfect. The guys on the webinar can't speak, but we do welcome your questions that you can ask via the text option. So I will keep quiet now and let Clive crack on.
Okay, thank you very much, Chris, and thanks to everybody for coming along and having a listen today. Yeah, so we're going to do 10 of these, and today we're going to break you in nice and gently with just a basic broad brush introduction to technical analysis, and just a bit of a background on myself and my journey, if you like, where I've got to, and some history of technical analysis and the basic chart types, just to get things going in a nice sort of simple manner that doesn't stretch us too much. So yeah, I said I'd talk about myself for a minute. I hope you don't mind. I have got 31 years experience in the markets, and for 16, well, actually, I think I should change that. That's 17 years now. I think I've been doing the job I'm doing now, which is a technical analyst on a daily basis. I write a newsletter, if you like, or a daily analysis for traders, and that's my company Futures Techs that does that. And we send our analysis out to professional traders mostly, although retail and day traders who are sitting at home, guys like yourselves, I guess, are also able to have a look at that analysis. So what's my journey? Well, on our screen there we have on the top right a picture of the futures floor in London, and that's where I started. I spent the 90s down there on the futures floor, and it was a fantastic time, thoroughly enjoyable, and it really did sort of set me on my way, if you like, with what I'm doing today, because down there on the floor, a lot of there's 3,000 people down there by the time we finished. By the time it closed down and went on the computers, which was a great shame. And when my job, I wasn't in the pits, I wasn't shouting and hollering. I always thought that I was a bit cleverer than that. I don't know whether I was, but that's what I thought. So I used to stand on the edges of the pit and talk to clients and try and get orders out of clients. Basically, the large institutional clients, you used to speak to them and say, this is what I think is going on today, and this is how you should potentially play the markets. And so there was two ways of doing that. You could either talk to them about the fundamental analysis, the figures that were coming out that day. If there was a GDP number, or if there was inflation numbers coming out, something like that, then you'd talk about that to them, and you'd say this is the expectations, and if we see a strong number, then the gilt market could sell off, something like that. And what used to happen quite a lot, which was rather exasperating, was that the number would come out, it would be stronger, but instead of selling off, the market would rally. And the nice thing about working in a room with 3,000 other people is you could turn around to anybody, and you got to know the people who were worth talking to, and you could say, am I going mad here? Am I stupid? Or was that a strange reaction to the numbers, because I think that we should have sold off on what was released rather than rallied? And it was the wise old sages down there, the ones that have been there a long time, the ones that had seen everything, if you like, who kind of said, well, the market doesn't want to go down, does it? Or, well, the trend is strong, or it doesn't want to go down. And so that sort of set me on my journey, really, because I thought, well, does it really matter why the number, why the market's going up or down, or what might move it. Maybe we just need to know where it's going, and the other thing, so the other side of that, I was looking at the support and resistance levels, and I was looking at charts, and they were quite primitive in those days, but I became known as a chart guy back then during that time, and people used to come to me and say, well, what do you think today, Clive? And I'd go, well, it's a pretty strong trend at the moment, and I think we should continue to go higher, and if we saw a dip down to 37, then that might be worth buying, and so, and that bit seemed to work. That bit seemed to resonate, and so that was why when the floor closed in '99, I set up my business, because I'd already gained a bit of a reputation as a chart guy, and so I started writing this analysis and sending it out to people every day by email on 56k landline, on 56k internet lines, and with a very, very slow computer. And I think I went through a few mice or mouses in those days, smashing them on the desk because everything was so slow, but it's got better, and here I am. And so yeah, the other thing I've done as part of my sort of journey, if you like, is I joined and then later became a board member of the UK Society of Technical Analysts, and this has been something that has been a major part of my career as a chartist, and I would highly recommend that if anything I say inspires you over the next over today or the next 10 weeks, and you think that charting's something for you, then I would highly recommend that you you join the society and get along to meetings where you can meet like-minded people, and there's an excellent education program around it all as well. I was asked in 2009 to write a book, so I wrote a book on candlestick charts. I think that is something we are going to spend some more time on in later weeks, so we can get round to to looking at that, and I've been honoured to be awarded several times for my the business as Futures Techs for the research that we do at the Technical Analyst Awards, most recently getting the best research house for commodities just earlier this year. So right, that's enough about me anyway. I mean, I think it's worth doing that background on me, just so you know I'm not some sort of robot at the end of the webinar here, and also just to give you the background of how I ended up looking at charts. So let's get on to our next slide, and the next slide is to do with and let's see if I can get this to click over. Yeah, there we go. Is to do with the different types of analysis that you do get in the markets, and obviously, the main one that gets the most attention, I guess, is fundamental analysis, if you like, where and probably the easiest example of that, economists basically, and also people who spend their lives working for these bulge bracket banks, and who look at stocks and look at companies and analyze what they think about the company based on the fundamentals, basically. Now, my favorite example of this failing rather miserably is the stock Enron back in 2001. There's plenty of examples since. I should probably find one that's more up to date, but it doesn't matter. Enron was rated a buy by every analyst on Wall Street in 2001, right up to when it went bankrupt. So 12 out of 15 had Enron as a strong buy, despite the fact that the share price had halved and halved again and halved again, literally over the course of the previous 3 months. And so, because what fundamental analysts do is they say, I think this company is worth $50 a share, and it's currently $25 a share, so I think you should buy them. If they then, over the next week, month, year, go down to $20 or $15, then the same people are going, well, I still think it's worth $50 a share, so I still think that they're worth buying. And what they're completely failing to grasp is, apart from the fact that it takes, you have to swallow your pride to say, okay, I got that wrong. But hopefully it's not just all about pride. What they fail to grasp is that if the trend is downwards, then and it comes back to what I said earlier about the old boys of the futures floor. If the trend is downwards and if sentiment is against something, then you don't really want to be getting in the way of that. It's the same when the trend is upwards, and something like this, what we're seeing in equity markets and things like Bitcoin at the moment, where the market is just going in one direction, basically, if you like, and you don't want to be trying to bat against that. Basically, I always think about, and we'll talk about this at another time. Let's stick to. I do have a tendency to go a little bit off base sometimes, but I'm going to try my best to stick to what's on the slides. Right, so. That's fundamental analysis in a nutshell, in my humble opinion, if you like. There's another way of looking at the markets that was championed a while back, called efficient market hypothesis. There's another name for it, called random walk theory. And this was championed by a couple of chaps, Eugene Farmer and Burton McKeel, and they set up a hedge fund. And that hedge fund was called Long-Term Capital Management, and was very successful for a while. And then one day, I think it was back in '97, there was a Russian debt crisis, and then there was a South American debt crisis, and 2 or 3 things happened within a week or so that, according to their mathematical models, aren't meant to happen all at once, and their hedge fund blew up and lost all the money, basically. And that sort of sent them scuttling to the sidelines, if you like. Technical analysis very much deals with the where. It's a little bit what I was saying about when I was on the futures floor. I'm not worried about why markets are going up or down. I'm worried about where they are and where they've come from. And markets do trend. They are not random, as our gentlemen Burton McKeel and Eugene Farmer thought. Markets are, that you do have trends, and these trends can and do persist. So it's a technical analyst's job to look for these trends, look for the turning points in these trends, if you like, as well. That's the more difficult bit, and to try and stay on top of what is the trend and when, if that's changing in any way, shape, or form. And the interesting thing about that, the idea of trends, is that the academia got hold of this and gave it a new name called behavioural finance, if you like. And I'm being reasonably simplistic and maybe somewhat flippant here, but just indulge me, hey. And they came up with something, a version of efficient market hypothesis, which says things are pretty random, but then occasionally emotion takes over, the emotion of the herd. That's why I've got a picture there of a bunch of sheep, all following each other, the herd instinct and other such things that are behavioural as opposed to rational, if you like, that can sometimes take over the markets and actually, well, so the conclusion is, and can produce trends. Well, hello. That's what us technical analysts are looking at. We're looking at the trends. So as far as I'm concerned, we're kind of squaring the peg. We're sort of going around in circles a little bit here. Some of the best traders and investors I have ever come across combine those things on the left-hand side. They know their fundamentals, they understand the economics of the market, but they use technical analysis as an additional tool, a tool for timing of trades and a tool for looking for where to put stops and where to set targets. So they will come up with, and I think this whole idea of I have an idea, I want to trade on the back of that idea, and that's all come from the fundamentals, but now I am going to switch and put my technical hat on to say, where shall I get in, where shall I get out if it goes wrong, and where can I get out and take profits, or how am I going to manage a trade once I'm in it? And this is the that's the eternal sort of that's the golden egg. There is no that's as close as you're going to get to a golden egg when it comes to trading. You may see a lot of training companies and the such like that are out there saying to you, we have this fail-safe system that's going to make you loads of money, and you've only got to do 15 minutes of work a day and that kind of thing. And I'm a bit cynical on that kind of thing, I'm afraid. Having been in the markets for 30 odd years, I would say to you that you need to have a skew on the fundamentals. You need to have access to news flow in some way, shape or form, and actually Twitter can be very good for that, and that's relatively free. It is free, but it's delayed probably. That's probably what I mean to say about that. You need to have technical analysis, which you can either, which is why you're here, I guess, listening to me, and hopefully I'll give you something that you can take away with you over the course of the weeks. But also, it's interesting, this behavioural thing, and while we're on the subject, you do also need to have a skew on what's going on in your own head, because you will only make a successful trader if you have all three of those things. If, in my humble opinion, if you've got an idea about the fundamentals, you know what's coming up news flow wise, or how to react to the things that come out that you don't know about. You're looking on your charts and able to read those, and you're also got things right in your own head, and you're able to deal with things like making losses and managing trades, and because fear and greed run the markets, and fear and greed run your head as well. Unfortunately, however much you can block that out, if you like. Anyway, I'm rambling again, aren't I? So let's crack on to the next slide. What is a chart? What does technical analysis do for us? Really, this is, I like this chart to sort of say to you, this is what it does. This chart is a history. This chart's a history of my career. Actually, this is the FTSE 100 over the course of my career in the city. I started in this, where's my mouse gone? There we go. I started right here, 1986, in the as a junior clerk in the stock market, and so my first year, as you can see, the FTSE had a very strong run actually, and then it crashed on October. We had the 30th anniversary of it very recently. We had a stock market crash. That happened in my first year in the city, and I think it was such a seminal moment for me, I think, possibly because I looked around at all these people that I'd got to know and respect, the older traders. They'd never seen anything like this, and they looked shell-shocked, they looked devastated, they looked like they didn't know what the heck was going on. And I just looked at it and thought, oh, isn't this fantastic? The market's going absolutely crazy. I love this. And so I think from that moment onwards, I was always just as happy or just as comfortable looking at a market that's going up or a market that's going down. And that's probably what led me into the futures market, because that was very much, the people in the futures market had the same sort of mindset with respect to that, whereas stockbrokers were always very sort of long only, if you like, and were only ever happy if the market was going up. So, they've been pretty happy for a while now. We had Black Wednesday here, 1992, and there was a bit of a blip on that, but then we got, and there's our Russian debt crisis right there in 1998, the thing I just talked about, where that hedge fund LTCM blew up, and that interrupted quite a meteoric rise in most stock markets, which was fueled by the .com rush and the which turned out to be a bubble, and the bubble burst and markets corrected all the way back. The FTSE lost half of its value. The Nasdaq lost 80% of its value. And I actually think that's interesting to think about that right now, because everybody's getting excited about cryptocurrencies. In fact, they're getting excited about Bitcoin in particular. And I think that we should remember that it was less than 20 years ago that everybody was getting excited about AOL and Alta Vista and all these wonderful search engines, Lycos. You might remember some of these names, or you might not, because actually they're history now. They've been consigned to history. They were victims of the bubble. The bubble burst and things reverted back to more sensible levels. Now that Nasdaq is back at those levels, and as we can see from our FTSE chart, if we look to the far right, top right of our chart, that has exceeded those levels from 1999. So yes, things have recovered, but it's taken a long time and it's been a very rocky path. And you know, it's now about Google and Apple as opposed to Alta Vista and Lycos, you know, who are. So I got to be, you know, my main. I'm very cynical about this Bitcoin thing that's going on at the moment. For exactly this reason, and I know it's something that's interesting lots of people, but I wonder whether cryptocurrencies may be a big thing in our lives in 10, 15, 20 years time, but Bitcoin won't be the you know, the bubble will burst, and a lot of people will be licking their wounds. So there's a little warning, I guess. Don't get too excited, and also, if it starts to drop, get out. Because actually one thing I saw throughout this period here, from 2000 to 2002, was a lot of very clever people who had invested on the way up here, who were not getting out of the markets. They stuck with it, and they lost a lot of money on the way back down. So we got to 2002, 2003, and then the central banks started to pump stimulus, you know, and we had low interest rates, and that pushed the market higher. And then we had the banking crisis and the Lehman bankruptcy, and that saw another big drop. And then we saw more stimulus, and now we're seeing the promises of tax reforms from Donald Trump, which are pushing the markets higher, and we're making new all-time highs in equity markets almost daily, especially on the other side of the pond. And all of these things that I can that I'm talking to you about can be, you know, they're there on the chart. That chart is a pictorial history, if you like, of everything that's gone on over the course of my career in the city. And I think that's a really interesting sort of way to think about it, is that, you know, you have the chart is telling you the story, if you like. And I think that's one reason why charts are popular, because they tell the story, if you like. So let's, what have we got for our next slide? I think it's a little bit of history. We've got some rather good looking chaps there. Charting probably came about and started being a thing in the 1700s, actually, with candlestick charts being used in Japan. And our chap there is alleged, on the top right, is allegedly a chap called, a picture of a chap called Munehisa Homma. And Homma was a rice trader in Japan in the 1700s, and he was so revered and such a big influence in the rice markets around that time, that Homma actually ended up being elevated to samurai status, which I think is a wonderful story. I think it basically sort of, you know, says to us, if you like, that oh, I've lost my thing there. Yeah, I think that says to us that that's something to aim for. If you want to become, you know, the best trader in the world, you're going to become a samurai trader, if you like. Now, our chap in the middle there is a chap called Charles Dow, and he had a partnership with a chap called Edward Jones. Does anybody want to guess what the partnership was called? Yes, you got it. Dow Jones. Okay, so they're the guys that sort of came up with Dow Jones, if you like, as an index, because Charles Dow, one of the things Charles Dow was mostly interested in was the relationship between the and we talk about 100 years ago here, the relationship between the industrial stocks and the transport stocks that were listed on the New York Stock Exchange at that time, and he spent a lot of time looking at the difference between these, and he said, well, actually, yeah, there's almost two different stock markets here. We've got the industrials and the transports, and he came up with, and he said, why don't we lump them together into indices, and we'll have a Dow Jones Industrial Average, which may sound familiar to you, but less familiar sounding might be the Dow Jones Transport Index. Now, there still is a transport index. Back then it was railroads. Now it is mostly airline stocks, to be honest with you. But so he was one of the early founding fathers of Western technical analysis, as we know it, if you like. And then we got to the 60s, the 70s, computers, people started to be able to use computers, you know, even though they were the size of a room, if you like. They were able to start using computers to power mathematical calculations, if you like. You know, there was some early forefathers of that, and as I say, later on, we're going in seminars later on, we're going to be able to sort of look at those other things as well, you know, some of those momentum indicators, if you like. So you know, that'll come later on in other seminars. We get to about 1980, and one of my favourite subjects, market profile, was invented or was formulated, and we're going to look at that in a later seminar as well. And now, you know, with computer power and bandwidth and internet more and more you know, freely available, I think that's allowed the affordability and the reach for technical analysis to improve exponentially. And you know, I think that's really, as far as technical analysis is concerned, that's leveled the playing field a lot more than maybe it has on other forms of analysis. And it means that a lot of the data that guys in the large banks and institutions have available to them, we also have available to us, and there's some excellent charting packages that are sort of coming out and that are available to you. So that is our little potted history, and that's and there's a bigger picture of our mate Charles Dow. Actually, incidentally, just anecdotally, there was a third partner in the business, and his name was Edward Bergstresser. And I always felt a bit sorry for Mr. Bergstresser. I think maybe on day one board meeting, they said, right, what should we call it? And I went, well, Dow Jones. Oh no, it's got to be Dow Jones and Bergstresser, isn't it? And the other two just laughed at him and went, oh, come off it, mate, that's too long. We'll just keep it at Dow Jones. Maybe I'm wrong. I have that's, but it always makes me giggle, that idea, maybe. And Charles Dow is a chap who came up with this idea of defining a trend, and his definition of a trend, very simple. An uptrend is a series of higher highs and higher lows. So actually, if we just click on there and go back, that's an uptrend where the highs are getting higher and the lows are getting higher. So all the time, if you're looking at a chart and it's doing that, then you are in an uptrend, you're in a rising market, and you want to be long, really. You know, you want to own stuff that's doing that, yeah, that's going up. And you know, how do you do that? You can buy dips and and we're going to talk about lots of different ways of being able to try and enter trades in line with the trend as we go through the 10-week course that we've got. And a downtrend is just the opposite. It's a series of lower highs and lower lows. And you know, if that's on your chart, then you either want to be short or you don't want to be owning this sort of thing. You know, so now it's not always that simple, and there can be at times and areas where the market is trendless or is not really showing you a firm trend. And obviously, again, that's, you know, if you can identify these different market conditions, then you're able to trade accordingly. If you are looking to, you know, if your fundamentals say to you, I want to buy something, and you look at the chart and it's going down, you can go, well, I'm not going to buy it at the moment. I'm going to wait until the chart's going up, and I'll buy it when it's I'll buy stuff that's going up. And yeah, so all sounds very simplistic, and it's not quite as simple as that, but let's just try and, you know, think about those sort of principles, if you like. Okay, so chart types. There is a very simple line chart, okay, and that is, you know, this is from the Div Markets platform. It's going to take you through to these charts. Most of the charts on the presentation, in fact, not all, but most. And so there's a line chart, nice and simple. We're just joining up closes. That's a daily line chart. We're just joining up closes. So each close just gets a, you know, the line joins one close to the other and plots, and that's actually the euro against the US dollar. It's a daily line chart, and it started back in January down here when the euro was at 105, and it's plotting and showing us that rise to 120, which we saw in early September, right around here, and then we've seen a sell-off which has accelerated in recent days, recent weeks, and has seen us back down to 116 as we do this, as we're talking today. Okay, so that's the most simple version of a chart, if you like. The Western version that gives you a little bit more information, that's been used for a long time in Western trading rooms, and is the bar chart. And a bar chart actually uses 4 pieces of information for each day and plots it on our chart, and you can see, and I've lost my mouse again, there it is, here we go. So each one of these bars is 1 day's worth of price action. The open is a line off to the left hand side, the close is a line off to the right hand side, and there's our range. I think everybody's probably fairly familiar and fairly happy with that concept. That's the same data as our line chart, okay? It's the same time frame, and it's the same instrument. It's just there's more data on there because the line chart is just giving us closes. There's your line chart with just closes. This adds into the equation the ranges of each day and the open as well. And this is the candlestick chart, which again, if I just flick between the two, there's our bar chart, there's our candlestick chart. They are pretty much the same, except we are applying a color scheme to the chart, and, you know, in adding color, I believe we are adding color. Okay, that's not just a pun. I strongly believe, which is probably why I was asked to write a book, that candlestick charts do add extra color to the chart and allow you to, they're a better visual. And again, we're actually, I think, 2 of the webinars that we're going to be doing over the 10 weeks are going to be devoted to candlestick charts. And this is the construction of a candlestick chart. You have 2 different colors. You have open or white or green candles, okay? Usually a light color. In most of the charts that I'm going to use throughout the 10 weeks, if we're looking at candlesticks, we're going to use this color scheme right here. Green for up candles, red for down candles. Okay, so if the market is bullish and if we're closing above where we open, then you will see lots of green on your chart, as you see here, here, here. This is green, 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 and the market's going up. And then if the market starts to go down, you will see more red candles than green candles. And we had a particularly large red candle on this pair only at the tail end of last week, which gave a pretty significant signal. We can talk about that a little bit later, and obviously by the time we hopefully get to the end of the 10 weeks, you won't need me to tell you all about it because you'll be doing this stuff yourself. That's, you know, that's the aim. 100 years ago, when Charles Dow was doing his thing, we were actually, this was the most popular, this was the most used form of charting, and this is something called point and figure charts, which is basically, I always call this noughts and crosses for adults. We have crosses to illustrate times when the market is going up, and then zeros for times when the market is going down. And again, what I've done here deliberately is use the same time frame for data on all of the charts that I'm showing you here. So the line chart, the bar chart, candlestick chart, and this point and figure chart are all showing you the euro over the course of 2017 so far. And you can see, you know, let's just flick through, you know, so there's our line chart, bar chart, candlestick chart, point and figure chart, all very similar looking, and because yes, they're using the same data basically, but expressing it in different ways. The point and figure chart, as I say, was widely used 100 years ago. There are still people I know out there who do like this form of analysis, and there's a chap in the UK called Jeremy Duplessis who is the absolute expert at this and has written a fantastic, exhaustive book. Exhaustive? I think that's the right word. I don't mean exhausting. I mean it's very thorough. Book on the subject, and he is a guru on this stuff, and so that's another charting type that we'll spend some time on at another time, you know, on later weeks. And this is a market profile chart, which is something that was only formulated in the 1980s by a futures trader in the US called Peter Steelmeyer. And that's the same data again, but you can see this shows it in a very different way, and looks a bit confusing and a bit nonsensical. But again, we'll spend a week on this later on in this series of webinars to try and demystify that a little bit and give you an idea of how that works. And basically, yeah, that's a form of analysis that I overlay and use in addition to my candlestick analysis, and I find that it can give you extra color and can confirm things or otherwise at times when maybe other charting methodologies aren't quite doing that. So it's and so then you would get, you know, and you can overlay things onto a chart, and this last chart looks like a bit noisy, and there's some bits and pieces on there that you sort of must be scratching your head about. Well, we've got some Bollinger Bands on there, we've got some Fibonacci lines on there, we've got an MACD indicator in here in the middle. And then down the bottom here we've got something called the RSI, which is the Relative Strength Index. And whilst none of that will make much sense to you at the moment, it's all subjects that I'm going to attempt to cover and give you some sort of idea about as we go through the course of these 10 weeks. So hopefully all of that has you know, piqued your interest, and make sure you come back to see us again. We've got, you know, the other thing there, we've got actually something called a head and shoulders on that chart, but again, that's something we'll talk about at another time. Everything pointing towards lower prices for that particular pair at the moment. So, yeah, technical analysis concerns itself with three core principles. And the three principles of technical analysis are that markets move in trends and trends persist, which we've talked about already. We've talked about the idea of trending. Charles Dow defined it. We want to be on the right side of it. And the things that move trends are fundamentals that are known, or then, you know, and then obviously unknown fundamentals can come along to either confirm trends or to change them. But also the things that can that can make trends are psychological and otherwise. And this is maybe where the fundamental guys miss out. They don't factor this in. The market has long periods of time where it is the sentiment is bullish or bearish towards a particular instrument, stock, market, currency, whatever. Okay. Second principle: price action is repetitive, i.e. we see repeating patterns in markets. Okay, markets are run by people. People do the same thing over and over again. They make the same mistakes over and over again. As a herd, we do the same things over and over again, and patterns emerge. And so technical analysis concerns itself with looking for patterns that have worked well in the past and therefore can and should and might work well in the future, and can give us a trade, if you like, or can give us a trading opportunity on the basis of that assumption that if it's worked before, it can work again in the future. Yeah, which has its normal sort of disclaimer, caveat of you know, past performance of anything not being a guarantee of future future returns, or whatever, you know, whatever the wording is on the disclaimers. But you know, basically what I'm saying there is that there are recurring patterns of behavior, and we do look for those as chartists, as technical analysts, and we try to you know, and we look and we make assumptions based on that. Last principle: everything's in the price. Okay, what we're saying is, you know, this is day one economics, GCSE, if you like. It's everything's in the price, that supply and demand curve. Okay, if there's more buyers than sellers, then the market will push higher. That pushes the price higher in order to attract sellers. Okay, and that's what moves markets up and down. So again, arguably, we don't need to know why something's going up or down. Okay, we deal with where. The why can be a bit mysterious sometimes, but the where we can track on the chart, and we can look for these trends, and we can know that the price of XYZ is there because of everything that's known about XYZ at that particular time, and everything that's thought about XYZ at that particular time as well. Okay, so not just everything that we know, but the sentiment is in the price as well, and that's an important thing. So what are we going to, you know, hopefully that's given you a bit of a taste of technical analysis if you've never come across it at all. I'm hoping that that'll mean you will come back and you will want more, and just go through what we're going to be looking at for the rest of the 10 weeks for our next 9 weeks. We're going to introduce support and resistance and pad out on that Charles Down thing, if you like, next week. Week 3 will be support and resistance again, and we'll be looking at trend lines and chart patterns and Fibonacci. So that's our, that's that recurring patterns of behavior thing coming in there. Weeks 4 and 5, we'll be looking at candlesticks. Candlesticks, probably my favorite subject, and something that we can really get into the nuts and bolts and give you that extra color, that extra information, if you like. Week 6, we'll look at Bollinger Bands and moving averages and how you can apply them to the charts, and their, the good and the bad with things like that. Week 7, we'll look at momentum indicators. As I say, those overlays that can give you extra information or confirmation or not. And then week 8, we're going to look at a thing called the Ichimoku Koku Kaiu charts, which is a bit of a tongue twister, but is a Japanese technique that is becoming more and more popular, and is something that you might want to have a look at. Week 9, market profile. Week 10, bringing it all together. What I'll try and do on the last week, and ideally, and what I'd like to see, I sound like a teacher here. I'd like to see you all I'd like to see you turning up at all the presentations, because what I'd like to do on the last week is almost make it interactive and sort of say, come on in, what have you been looking at, and how, what are you, and I want questions, and I want people, I want you to sort of, we can work together, and we can say, and we can look at some charts and some live examples and try and just say, well, bringing it all together, because I think there will be things in there that you don't like, and there'll be things that you do like, and so your challenge, if you like, is to try and work out the things that you think could work together for you. If you are a reader and you want to try and get your head in a book about technical analysis, the best book probably to have a look at as a starting point is Technical Analysis of the Financial Markets by John J. Murphy. It is widely regarded as the sort of catch-all Bible, if you like. I've also met John Murphy, and he's a thoroughly nice chap, so that's another reason to recommend that one. If you want to read a book on candlestick charts, it'd be rude for me not to suggest my own book, surely, and that's what it looks like, so there you go. And another couple of books that I always recommend to anybody who's starting out in the markets that are worth a read is the Mighty Fine Reminiscences of a Stock Operator by Edwin Lefebvre. That is not a textbook, that is a story. and it is a great story, and it is a really interesting story. It's a fascinating story with lots of sort of mini snippet lessons in there, and things that you can apply to markets. It's 100 years old, this book. But it's amazing, and I would highly recommend reading that book to anybody. And the last book that is probably on the recommended list, or my recommended list, would be Market Wizards: Interviews with Top Traders by Jack Schrager. And again, lots in there for you to think about if you are an aspiring trader or even an experienced trader. I would say that Market Wizards is one for you. So that, my friends, concludes the slides bit of the talk. I am more than happy to answer any questions people may have, or we could spend a few minutes looking at some live chart some up-to-date charts, and I can give you a quick overview or some quick thoughts on some major markets and what my thoughts are on the charts on those. Obviously, I'll be using stuff that I haven't spoken to you about yet, but please do shout anything over that you want to ask about. Chris, I seem to have lost the panel that's got the questions on it. Actually, are we getting any questions coming through?
Hi, Clive. Yeah, we've just got a couple come through. I can see that, so I can get them across to you.
Okay, that's great. Please. Yeah, sorry, I don't know what's happened to that. So, have we got a question there of how do we apply technical analysis on a new market or a stock or a currency, for example, cryptocurrencies or an IPO? An IPO you can't, because you haven't got price history. Quite simply, you need price history in order to be able to chart something, and if it's an IPO, then obviously you haven't got that, so you are unable to do that, quite simply, in a nutshell. So no. How about Bitcoin? I'm being asked. I'm not a big fan, but hey, let's see if this will give us a Bitcoin chart, and we can try and I haven't actually spent a lot of time analysing Bitcoin, if I'm honest with you, but I can try and get it up, and we'll just have a quick look, shall we? Bitcoin, and I will look on Trading View for this. I'll drag it across for you. Right, Bitcoin. Oh, hang on a minute. Let's go with an interactive chart, please. This is on Trading View, which is available through DF Markets. I don't want the point and figure chart because I don't really use them. Candlestick chart. Okay, Bitcoin. There's a chart. Okay, this is a daily chart, and we saw a spike there. Is it a daily chart? No, it's an hourly chart. Let's go to the daily first of all. Okay. Spiked up to 62 something on Monday. There's an uptrend line there. Okay, that's the main thing. That's already on that chart. So I lied when I said I haven't looked at it at all, because I obviously have, and I've got myself an uptrend line on there, and that uptrend line is saying this market is going up. Okay, so that's that really. The trend is higher. There's nothing to argue about with respect to that at the moment. We are appearing, this candlestick says to me that we are finding sellers when we get above 61,000, and again we saw a little bit of upper shadow there. We'll discuss that in later weeks, the idea that the candlesticks can actually give you hints as to where sellers may be returning, but right now that Bitcoin chart, that daily chart, in a nutshell, says we're in an uptrend, and unless we break, let's just give me a second, people. I'm going to try and extend this so I know where that line is now. No, that's not it. We want that. All right, and we'll format the trend line and we'll extend it to the right. Okay, and that says that 58,000 is where that trend line is. And so a 10-second analysis of this says to us it's bullish unless it breaks 58,000, and breaking 58,000 would be the first indication of anything going wrong, if you like. But all the time we're above the trend line, the market's bullish, and that's that. Are charts for markets that don't trade 24 hours harder to read as there's more gaps, etc.? We're going to talk about gaps in a later seminar. I will make sure we do that. I actually like gaps because gaps can provide you with support and resistance, and actually give you better patterns, and they actually provide more information, I think. So I'm actually a fan, and I'm able to. I can show you this on my own charting system here, right? This is the Dow. And this chart here is the 24-hour, the all sessions chart for the futures. Okay, so that is every single, and there are no price gaps in that because this is a 24-hour market. Okay, but I am able to build this as well, and this is the chart with the overnight trade stripped out, if you like. Okay, so we've taken out the overnight trade. And what you can see on this chart is times like this where it opens up, here on this day here. If we look at that one in particular, we opened above the previous day's high, so we gapped higher, and then we came down and we found buyers when we filled the gap and then rallied again. And that kind of thing is really rather lovely, and then you just keep looking across. Found buyers there after filling that gap. And now we're seeing gaps here. We're seeing more and more gaps on this, on the Dow now, and actually that's starting to worry me. And you can go away. And when you see lots of gaps appearing at high levels, that can be a warning sign of a reversal. So that's something to watch out for. Another question said at the beginning, fundamental analysis define why. So I understand that with only technical, we can't have a long-term investment strategy. I don't agree with that. Well, you can have a long-term investment strategy with technical analysis, but you have to use long-term technicals. I am part of a investment committee for a small fund, and we have a model that uses things like the 200-day moving average and some longer-term technical studies to say to us where we should be putting our money. So you can have a long-term investment strategy using technical analysis, but it's probably and asset allocation. You can say technical. The charts can tell you whether your money should be in bonds or equities or gold or commodities, that kind of thing as well. You just have to use a different set of tools, really. Okay, that would be my answer to that. We can pad out these sort of things in later weeks because I think we're starting to run out of time for today. But can you use your price levels combined with data coming out? When you have a piece of economic data due for release, I strongly believe that you can place, you can place orders at technical levels that are above and below the market, because I've seen evidence of markets hitting technical levels on whippy moves on economic releases and then reversing. I think you have to be a bit careful with that, and obviously my least favourite day of the month is the first Friday of every month, non-farm payroll release in the States, because I think it's a lottery. But again, I know many traders who, I will put my technical levels on the chart, and if I see the markets responding to the numbers by hitting these levels and then reversing very quickly, then there's something to do there, and that is a way of combining the technicals with the fundamentals and the data. The problem obviously with that is that the technicals generally don't tell you what the number's going to be, so you have to wait for that. I've got a question from Andrew asking if I prefer daily chart trading or hourly chart trading or even a lesser time frame. Andrew, this is one of those things that's a bit of a sort of one of those "how long is a piece of string" type questions, and I think that and the technical analysis that you use will entirely depend on actually that question. You know, you have something that you need to work out for yourself is what works for you, because what works for me isn't necessarily going to work for you. And once you do know whether you are a shorter term time frame trader or a longer term time frame trader, then you can work out which time frame charts you want to look at. And you know, and so you, and that's, but we can touch on these themes again in later weeks, and I think it's an interesting question, but at the same time I think that's a very personal thing. But I'll wrap this up, that question, the answer to that question, and actually we'll wrap the whole thing up by saying that I never use just one time frame of chart. I like my charts to cover several time frames, and even if you are using hourlies or lesser time frames, you should always have a look at what's on the bigger picture charts, what's on the dailies, the weeklies, even the monthlies. Have a look at them at least once a week or once a day, because that bigger picture context is very important, and sometimes that can change without you even realizing. And so you can get married to an idea, if you like, and I've seen many people do it over the years, and then you can lose track that actually things aren't quite as bullish as they seem, and I think actually the chart we've got right there on the screen is a reasonably interesting illustration of that, because everybody thinks that the Dow is in this rampant bull market, but what we've seen over the last week actually is some uncertainty, and we haven't made it, and we're not making new highs. The Nasdaq did yesterday, but this one didn't. So maybe that isn't quite as bullish as as we think, if you like. So there's maybe a small example of having a look at those bigger picture time frames and knowing the context of which you are that you're trading in. Right, thank you very much for listening, everybody, and I really hope that we see you all, or you all come back to have another listen this time next week.
Clive, thank you very much. What is next week's webinar?
Next week's webinar, I do believe we're having a look at candlesticks. No, support and resistance. That's it.
Brilliant.
Support and resistance, part
Brilliant.
1.
Well,
okay.
Thank you ever so much, Clive. Thank you everyone for attending, and hopefully we'll see you all next week.